Hey everyone, David Oliver here with the Tax to Save team. Thanks for joining us this week. This week we have a really exciting case study. As we get closer to the end of the year, it's crazy today. We're basically almost in the year, right? It's finally upon us. But for those that are listening today, is there's still time to save tax in 2025? Yes. For those that are also listening today, I don't want to be rushed. Well, maybe 2026 is better for timing and what you can achieve and what you want to do to save yourself tax because you can never be too prepared, but you can definitely not leave yourself enough time if you don't give yourself enough time to get educated, understand your situation, and understand really what you can do. That's really the purpose of today's case study, showing two things. So today's going to be a two for one of a client situation, the tax bill that we're facing, and then two strategies and businesses and investments we help them put into play and what it did to their overall tax bill. So as we always do, we'll pull up today's case study. We'll look at the return alongside the actual scenario and what's happening on that return and walk us through it. So I'll go ahead and share my screen and we'll get right into it here. So as you always do, or we always do, right? We have the return here, right? We have this client making W-2 income. They're making, good W-2 income, about 350 grand for this year of 25. And you can see here, right? They also have, they're out of the state of Virginia. They have some interest, some dividend income, but the big thing is this Roth conversion on line 5B. Did a $500,000 Roth conversion. This client really had a lot of tax deferred assets, and for their situation, this was the amount that made sense for their this year of working with us. And they also had some capital gains, as you see here on line 7 of 166,000. So all in, all this income between W-2, Roth conversion, and capital gains, they had an income of $1,020,746 in the state of Virginia, married filing. And you can see here, all right, they're in that $350,000 federal and state tax burden with no strategy or implementation of planning put into play. So what do we do, right? Like I promised, we got a two for one today. This client used two great businesses that he liked of how the business models worked they didn't have before because he's a believer in the assets and what the assets delivered from a revenue perspective, not just as another way to save him tax. Again, these are real, tangible, active businesses that this client implemented, but not having to do too much. And we'll talk about that. So with that said, right, we have that he implemented one strategy being an equipment leasing strategy. So he implemented a business, helped him create a single member LLC, used some leverage financing, putting as little as 10% down, 50 grand out of his pocket to get a $500,000 equipment purchase in Section 168 bonus depreciation expense for his business now of $500,000. So you see here on line 8, right? That's part of where that deduction's coming from. That wasn't the only business with an equipment expense he had, though. The other thing he liked is he's a big believer in the Bitcoin space. He wants to stack as much Bitcoin as we can. So we helped him create a business around Bitcoin mining. Now, he's having these miners being hosted. He's paying them to be hosted up in Texas with cheap energy and a fixed energy cost of some leftover wind turbine energy. But this is his business of providing compute to the network and being paid in Bitcoin as his business revenue and his miners, his equipment expense put off that revenue. But he's able to expense year one all of that deduction, all of that expense for the computers and the energy costs themselves. And so here he invested $258,000 to get a $258,000 year one deduction as well. So the total outlay was $308,000 to get $758,000 in deduction. Well, why is line 8 only showing 642,000? This is something that's interesting called business loss limitations. It basically means that because these are new businesses for him, and that not all of his income is coming from these said businesses of the million plus he has, the government caps him with these new businesses at a loss limitation of 626,000. If you do have business income, which he did, so real estate, he's able to add that loss another 20 some grand to his bottom line and now have 642,000 of deduction he gets to use. Now, the $758,000 of deduction does not go away. In fact, just carries forward for him to be used next year for more conversion and other income that he'll have being an employee. So Before strategy, as you see here, right, we're looking at $1 million plus of income, $350,000 tax burden. After strategy, as you see here, his income's now at 378, and his federal tax burden in state has fallen to literally $54,000. So the big reveal here, right? Now, this was a client doing multiple strategy, really liked to both fit his circumstances and goals. And right there, he was able to get a 96.2 return on tax alone, right? So again, we went from, as we enter 2026, right? Just to kind of talk about this again, he saved $296,000 in taxes on a $300,000 investment outlay. That doesn't count the business in Bitcoin he's stacking, doesn't count the cash flow from his equipment leasing business that he also has, a lot of different great variables that compound, again, the tangibility and the effect of the benefit of the businesses we've helped him implement here. So with that, what does he have going forward, right? So he still has 115,000 of his $758,000 of deduction to carry forward into 2026. Assuming his income's same income as last year, right? That right there saves him another $40,000 of tax savings on top of his already 297,000 of tax savings. So year one, right? Total investment of 308,000. You get a total tax savings between year one and two of $335,000. So in a 2-year ROI, return on tax alone, people. Again, we're not talking anything else with the business. Just the return on tax savings, the guaranteed part of this was 109% return on tax. And so that's what we achieved, right? And it's all very in a systematic plan for this client's circumstances. For those that are wondering, hey, is there still time for me to save tax? There are many other strategies. This is the two strategies the client enjoyed, educated himself, and involved himself with this year. There's still other strategies that we can still implement, still educate, and have you implement for yourself this year. And we can talk about that. Check us out at taxessave.com to have your own free discovery meeting to learn about your tax risk and what you can still do to mitigate this year of 25 or to do to get a head start on 2026 tax planning. Because it's never too soon, but it can be too late. Thank you. We'll see you there.